And that's why they coin the TT Gang strat, which is the best freaking option strat I learned ever. It's just freaking amazing. After a recent video that I made regarding the risks of option writing, it seems like through reading the comments, a lot of people think that I do not write options, and that I think that options are like the devil and that you should never touch options. I am far from that. I like writing options. I like buying options pretty often for multiple reasons. It's just a really good source of not necessarily passive income, but good recurring source of income for holding stocks. And I think that it's actually a really good thing to look into if you do have the time to learn about it and to familiarize yourself with the risks, with the rewards, and with the nuances and everything regarding options. So there's actually quite a few things, so much so that I'm gonna make this video. This video is gonna talk about 4 or 5 different tips I have regarding writing options that I learned throughout my writing option career. So without further ado, let's begin. So the first one is you can leave your option whenever you want. You can buy to close or you can sell to close your option whenever you want. This, I feel like, is something that a lot of people don't realize, or they just are adverse to doing it just because they feel like they have to squeeze every single last cent out of the option before they go on to write their next option. The truth is, you can close your option whenever you want. If you think that things are going sour for your option, you think it's going up and you're already negative 20%, you don't have to wait until expiration. You can just close it early and then hopefully write another option that will expose you to less risk. Or if you think you've gained a lot, let's say you wrote an option at like 11 a.m. market time. Something happens, something crazy happens, and then you're up 50% on your option, you're up 30%, you're up 10% on your option. That's still money. You can close whenever you want. Just buy to close your option. Just sell to close your option. You are not stuck holding that until expiration, and you're not stuck holding that until you have to hit 50% profit, or until you hit 75% of the total possible gains that you will earn. You can close whenever you want. That is a very important thing that I want to drill in everyone's head with regards to options. When you have an option, either you buy or sell, you can close it whenever you want. It doesn't matter. Okay? Next tip regarding options is do not be lured in by the juicy, massive premiums that are involved in certain options. There is a reason why those premiums are so high. It's because the mass majority of the market believes that that option is somewhat risky. Now, if you've done your due diligence, you accept the risks and you know the reward, right? In that case, then go ahead. But do not just think, oh, this option offers me 50% of the total collateral that I have to put into it, or this option is offering me 50% on the risk that I'm taking, I should take it. There is a reason why that option is so expensive. It's because of how volatile the stock is. Maybe just everyone in the market believes that that stock is going to go up really high or going to go bankrupt or whatever, right? I have been burned by this. I've also earned a lot of money from this. It really depends. You have to do your research and you have to accept the risks that are going to happen. I wrote put options. I wrote cash secured puts on what's it called? What was the ticker? FRC, First Republic Bank. There we go. I wrote cash secured puts on First Republic Bank. It went bankrupt. There are risks. The premiums are juicy. They do create a lot of cushion for in case poop does hit the fan. But the reason why it's so expensive is because people are expecting poop to actually hit the fan. So, or for it to skyrocket to infinity, right? I've also written options on GameStop, and then it just rocket ship to the moon. And I've just been like, damn it, I missed out on gains. But do understand that premiums are high for a reason. Premiums are low for a reason. It has to do with the perceived risks or the perceived movement of the stock. Tip number 3. It seems like all the influencers and all the people that are promoting or kind of teaching how to write options, they always say you can never lose. You always have an out when you write options. There's always the chance to roll over. You can always roll over your calls if things go up to the moon. You can always roll over your puts if things drop down too much, more than you expected. That is true. You can almost always roll over. But do realize, what is the opportunity cost of you rolling over? I want to say this again. think about the opportunity cost of you rolling over that call for an extra 3 months, extra 4 months, extra 5 months. You rolling over that put for an extra 3 months, 4 months, 5 months. Yes, you can increase or decrease the strike price, but think about how much money you're actually earning and the amount of time that you're allocating for that stock to earn you that much money. Let's say you wrote a call for an option strike price of $10 and the stock goes up to $25. Would you roll an extra 6 months, 9 months, a year to increase the strike price by $1 or $2? You really have to think about how much money you could be leaving on the table, because you have to think about, okay, so if I were to just roll over, I would earn this $2, but I'd still be holding the stock. But there are many more opportunities in the stock market. Maybe what if you just sold out of that position, you obtained your $1,000, and then you use that $1,000 to buy something else and then write options on that. Or maybe you used it to maybe do the wheel strategy and you wrote cash secured puts. Would you be able to earn more money than you would have if you rolled out that option 6 months, 9 months, a year for an extra $1 or $2 in premium? You really have to do this balancing in your mind and really calculate how much money you could be earning if you were to just exit out of that trade altogether, right? You take what gains you got from writing that call or from writing that put, and you just move on to something else. Yes, it's true that you can roll out to basically infinity, right? You can roll out forever for the life of you, but is it worth it? Is it worth the opportunity cost when you could? The market has thousands, if not millions, of different things you can put your money into, right? Is you increasing that strike price by $1 really worth it? Is the act of decreasing that strike price by $1 really worth it? Oftentimes, I would say it isn't worth it, but a lot of times I see that options writers, they experience some sense of FOMO when they hold the stock and they don't want to get rid of it, so they just roll their strike price up $1, up $2, up $5, when you could put that money into anything else and you can maybe see a similar gain or even a better gain. So that is a really important lesson. I feel that a lot of people have to realize that yes, you can roll out indefinitely, but please compare the opportunity cost of rolling out as opposed to doing something else with that money. And the next thing to note about selling options is, I don't know what it is about option sellers, but when they say return on money, they're always calculating it from premium. Let me just give you an example, which is something that annoys me. Let's say you sold a $30 put on some random stock and you got $200 in premium. In a week, you bought it back for $100. What is the return in that transaction? If you said 50%, no, it is not 50%. Okay, you are risking $2,800 because you have a $30 strike. That's $3,000, right? You got $200 in premium, so that means you're risking $2,800, right? And then you got $100 in return, right? So it's not a 50% return rate. It is a 1 out of 28. I don't know what is that, like 3%? I think around 3%. That's like 3 point something, whatever. Around 3% return rate. Do not inflate your ego and say that you got a 50% return on your money. You got 50% of the premium that you expected to get, but you did not get a 50% return on your money. Those are different things. Please, don't. It annoys me so much when people say, "Oh, I got 50% return on my money." No, you did not. No, you did not. Stop it. And the last tip I have on writing options that I think is actually very important is, I just don't like writing options on Robinhood. Now, I do write some options on Robinhood just because that's where I have some of my Roth, some of my retirement funds, but I just don't like writing options on Robinhood. There's 2 reasons why. The first one, their fail rates and their payment for overflow on options is absolutely ridiculous. There are many times in my case, I have a Schwab account and I have a Robinhood account. I've noticed multiple times, and I think every single time I've done this, if I write the same option on both Robinhood and Schwab, the Schwab account will oftentimes fill much faster and much sooner than the Robinhood account will. This basically just signifies that Robinhood has a much higher payment for overflow as opposed to Schwab. So let's say I'm writing a GameStop option, let's say weeklies, and it's 80 cents, right? I have a limit sell at 80 cents. Sometimes the Schwab account will fill and the Robinhood account will just never fill. It will just never fill because Robinhood, they signal that they're selling your option for 80 cents. It usually means that they're selling your option for, let's say, 85 cents, but then they're only giving you 80 cents, if that makes sense. So they're taking the what's it called? They're taking the slippage, I guess. I guess it's kind of like slippage. So they're taking the slippage away from that. In that case, then they're taking that 5-cent spread. So I like writing limit sells that are close to the ask price, like a little bit off from the ask price, but they're close to the ask price. And sometimes if you're writing at the peak of the market or if you're writing at the dip of the market, then oftentimes you don't get that fill because of that insane slippage that Robinhood has, which I do not see in Schwab. So that's something to take note of. The other thing, and I think the best tip that I have for writing options, and this is my favorite tip for writing options that I feel like everyone should know because it's legit just, okay, it's not free money, but it's borderline close to it. And it's freaking amazing. I call it the double theta gang strat or the TT gang strat. TT gang. Anyways, so what do you do in order to do the TT gang strat? It's actually amazing. So on Schwab, on Fidelity, on a lot of these different brokerages, they allow you to, after you write a cash secured put, you can use the money that's held for collateral in that cash secured put. Then you can put that into maybe a money market fund, into some type of treasury bond fund, right? So in the case of Schwab, they have SWVXX, which offers, I think at this point, I want to say 5% yield, maybe, no, I think it's 4%. It's like 4 point something percent. I'll leave it here somewhere, but 4 point something percent. So that means that while you're earning money selling cash secured puts, with that cash that you have, you can also take that cash and put that into a money fund, a market money fund, and you earn an additional 4% in addition to the premium that you're earning on your cash secured put. Isn't that not crazy? So you legit just add 4% to however much percentage gain that you're earning on your cash secured put. It just feels like free money. I don't know. And the reason why I like writing on Schwab is that Robinhood does not let you do that. Robinhood always, like, they always advertise, oh, we offer 5% return on the uninvested cash in your brokerage account, but they will not do that on the money held for collateral in cash secured puts. So yeah, you can earn 5% on just money just sitting there not doing anything. Or if you write a cash secured put in, let's say, Schwab or Fidelity, those are the two that I know for sure that you do that. But let's say you're writing it on Schwab, you get the premium from the cash secured put. You also get yield of 4%, around 4%, from putting that into SWVXX. Now, again, Schwab isn't the only one. I know for sure Fidelity lets you do it. I don't know about any other ones. Those are just the two that I know of. But that's amazing. So you get it. It's like free money. I don't want to say it's free money, but it's almost like free money, right? Your money is working 2 times as hard for you if you're putting it in Schwab as opposed to if you're putting it in Robinhood. That's just amazing. That's just amazing. And that's what I coin the TT gang strat, which is the best freaking option strat I learned ever. It's just freaking amazing. Those are just some of the lessons that I learned and some of the nuances regarding options. To summarize, I do write options. I love selling options. I think it is a wonderful tool in order to get a secondary stream of income. And these are just some of the tips that I came across when writing options, when selling options, that I think that everyone should know of. And especially this TT gang strat that I talk about, it is absolutely game changing. You're legit, like, why? That is something that so many people are missing out on, and I feel like so many people should know. When you're writing options, just please know that you can do that. You can do that. It's freaking amazing. And that's all I wanted to talk about. So yeah, peace. Have a good day.